Hey guys, what's up? Alec back with the daily stock market, and look at that fairly red day in the markets today. Coinbase leading the pack, down 12%. NEO is not far after that, down 8% on the day. Okay, we had a lot of movement in the pre-market. We can see that Upwork was down 5% right away. But what everyone wants to know about today is Nvidia. What's going on? We have them up 2.2% after hours, but they came in with an EPS miss. So let's dive into it in this video. We also had Target report earnings today. They're down 13% from bad earnings, so we'll dive into what happened there. And we also have Alibaba reporting tomorrow morning, so stay tuned throughout this entire video so you don't miss out on any of those important stock market updates. So first up, we have Nvidia up 9% in the past week, up 38% in the past month. So we did see a big rally from $120 per share up to $160 per share. Now, I first want to start off this video and this segment of the video by saying Nvidia I do believe in for long term. So whatever happens in the short term, it still is down 45% in the past year. And I think if you're a long-term investor planning to hold for 3 years or more, you're going to be in good shape with a stock like Nvidia inside your portfolio. All right. Now, with that being said, I do want my average cost closer to $135 per share or under, which I definitely think we'll see Nvidia closer to $135 per share once again. So I'm a little bit more patient with my buying right now. So here we see more information on Nvidia. The PE ratio, by the way, 54 on the PE ratio, implying it's a little bit overvalued, but for a company like Nvidia, 54 is really not that bad. We also see a market cap of 400 billion. So I want to see that under 350 billion and closer to 300 billion. We have a lot of volume being traded on Nvidia, obviously because of their earnings. Some headlines we see: Nvidia profit chopped in half along with gaming sales as chip makers are adapting. Okay, Nvidia beats estimates on revenue. Gaming segment also tops expectations. Nvidia posted 5.9 billion in revenue for fiscal third quarter, beating the estimates. The gaming segment, which includes crypto-related revenue, also topped expectations, which is pretty rare because pretty unexpected, I should say, because the big Ethereum upgrade when everything switched to proof of stake from proof of work used a lot less computing power than proof of work rather than before other quarters in the past. So it was a little bit of a surprise that we did see that. We actually saw Nvidia say, we believe the recent transition in verifying Ethereum cryptocurrency transactions from proof of work to proof of stake has reduced the utility in GPUs for the cryptocurrency mining. The company said in a statement, this may have contributed to the increased aftermarket sales of our GPUs in certain markets, potentially impacting demand for some of our products, particularly in the low end. Nvidia has been saying since the first quarter of this year that it's expected cryptocurrency mining to take a diminishing contribution to gaming demand, though it couldn't quantify the extent of the decline. Okay, adjusted earnings per share of 58 cents missed the estimates of 71 cents per share. So that's the big headline that everyone's honing in on, is the profitability is shrinking, and that was a very big miss on EPS, by the way. The company forecasted revenue of $6 billion for next quarter, plus or minus 2% in the current quarter, matching estimates. Shares of Nvidia dropped by around 50% over the past year, admin supply chain problem, and the cloudy global economic outlook. Okay, so overall, yes, Nvidia is still down from $300 per share, and even $350 per share, they almost got up to at one point. So, like I said, I do want to see more of a haircut on Nvidia. We're already down around 50%, but if we can drop closer to that $130 mark, $115 mark, I will definitely be putting my hands in the cookie jar and taking out some Nvidia shares for long-term investing. Okay, so if we go to Nvidia's income statement and balance sheet, we can see, starting off with the net income on the income statement, we can see that they have been growing their net income. If we go to quarter over quarter, we can see that it significantly shrinking since Q4 2022, which is when we saw a $3 billion quarter, and now we're seeing it shrinking closer to $650 million on a quarter. Okay, that's for net income. If we go over to total revenue, we can see that total revenue is staying a little bit consistent. However, it's shrinking. That's a red flag on the quarterly revenue. However, the yearly revenue is continuing to increase, which is why everyone loves Nvidia. It's because they think that that revenue can continue to increase year over year for the next 3 to 5 years, which is definitely a strong possibility. Also, they have a strong balance sheet, coming in at 39% debt to asset ratio, which is really good. You know, it's not exactly where I want it, which is under 30%. However, I will take it for a company like Nvidia. All right, assets are a lot higher, 44 billion in assets and only 17 billion in liabilities. So they don't have any risk at going under or bankrupt anytime soon. Money's pretty safe in them right now. We just want to keep an eye on that balance sheet quarter over quarter and make sure that those liabilities aren't creeping higher and higher and higher, and those assets aren't creeping lower and lower and lower. So that's a big red flag if we start to see that. Now, if we go to analyst forecast, we can see that they have a 20% average upside on Nvidia to around $192 per share in the next 12 months. Right now, it's at $159 per share. On the low end, we see analysts all the way as low as $133 per share in the next 12 months. On the high end, we have analysts coming in at $320 per share. These were all just reiterated just recently. We have a top 25 analyst coming in, Christopher Rowland, which is average return of 22% and a success rate of 70. Okay, he just reiterated this 3 days ago with a price target of $180 per share in the next 12 months for an Nvidia. We also had another top 25 analyst, a few more top 25 analysts coming in at above or $200 per share or above. And these were just reiterated in the last 6 days, reiterated in the last 9 days, and also in the last 22 days. So they're fairly recently, and Rick from Oppenheimer Group says $225 per share for Nvidia in the next 12 months. Now let's talk about what's going on with Target. We'll try to compare it against Walmart as much as possible, but I don't want this video to be too long, so we'll try to make it quick. All right, so Target down 13% pre-market after the earnings release. In the last 3 months, it's down 12%. In the last year, it's down 40%, almost the same as Nvidia, right? All right, but in the last 5 years, it's up 150%. So let's dive into some specifics around Target, and then we'll go over price targets at the end of the segment. Okay, so we see a 20 PE ratio implying that it is a pretty great deal right now. Dividend yield of 2.1%. And also a 52-week high of 260, with the volume is extremely high compared to the average volume, and that's just because it reported earnings just yesterday, well actually today in the pre-market, and it fell a considerable amount. So a lot of people tried to play it on the way up. A lot of people were buying calls in the pre-market around 6:30. So here we see an article saying Target and Walmart are taking diverging paths after earnings. One went up, one went down. There was a lot of expectations to fill from Walmart because Walmart had really great earnings. So Target expectations were really high, and when they disappointed, it was a shocker, which caused them to fall a bunch. There are some disadvantages to reporting earnings after one of your peers in the sector, especially when they're one of the top dogs. The major one is the company reporting first can set up extremely high bar for the second one to clear. That is certainly the case with Target, which reported the day after Walmart had a blowout third quarter earnings. Historically, Walmart has benefited when inflation and economic softness crimps shoppers' budgets because of its focus on lower price and greater percentages of sales from consumables. Target, on the other hand, is largely associated with higher income earners, as more of its sales stem from discretionary categories like apparel and home goods. The starkly different scenarios at the two retailers suggest that higher income earners might be taking a bigger hit in the current economic environment, even if they remain better overall. Spending patterns at the two large retailers indicate that wealthier Americans might be feeling weary in the wake of big layoffs in tech, and while other white-collar professionals. And as stocks, which they overwhelmingly own versus low-income earners, have taken a beating. By one count, there have been more than 1,000 rounds of layoffs in tech industries alone, and as Barron has noted before, job losses cut much deeper into American spending than inflation, even when the latter sits at record levels. Some things to watch out for with Target is it's considerably smaller than Walmart and Amazon, also leaving comparatively little leverage with vendors and forcing it to compete in a world in which most product searches start on competitors' websites. The inflationary environment complicates Target's cost profile while increasing demand volatility, which we just talked about. The retail environment is intensely competitive, raising customers' expectations for services while extracting price pressure. But let's look at the numbers. We've seen the EPS in the past pretty good from Target with around 2.5 is the EPS, but then we saw it going lower below $1 on the EPS. If we pull out to the income statement and look quarter over quarter, we can see that the net income is drastically going down from 1.8 billion all the way to 183 million. However, if we pull out to the yearly, we can see that the net income has been pretty good overall, growing from 2.5 billion all the way to 6.9 billion. So as long as they keep up the year over year trend on the net income growth, I think Target will just be fine. I want to see, in order to buy Target, I do want to see that they are growing their net income year over year more than they are, because right now it's looking like a disaster on the quarter over quarter. The revenue, however, doesn't look as bad. Obviously, it's not growing at extreme numbers, but companies like Walmart and Target, we're not looking for huge revenue growth because they're already so big. We're looking for consistency. We also can see that the balance sheet has a 73% debt to asset ratio. And if we go look at the quarter over quarter, we can see that it's going higher and higher and higher, that debt to asset ratio, which is a red flag. All right, so we really need to see that debt to asset ratio getting under control, because the last 4 quarters, that bottom orange number is just increasing, which we definitely don't want to see. Huge red flag for bankruptcy. Not saying that I think Target will get to that bankruptcy level, but that's just a red flag for bankruptcy in general. Now let's compare against Walmart. So let's scroll down. Let's look at that net income. All right, it's not looking as good as Target. Target's is looking bad. Walmart's is looking worse. Here we can see that they actually reported a negative number for a quarterly earnings, negative 1.7 billion, all the way there on the right. If we pull out to the annual, we can see that they're also not growing their net income like something like Target. They're also not growing their revenue as much as Target. All right, obviously they are bigger, so they're not going to be growing as quickly as something like Target. All right, and if we scroll down to the balance sheet, that's where Walmart does have Target beat, only 62% debt to asset ratio, which is definitely better than what we were looking at for Target. And we can see that the debt asset ratio is growing and growing and growing quarter over quarter, which is another red flag. So overall, I would say Target is the winner in this case. However, I'm not inclined to buy Walmart yet. I really want to see more pain, and I think if the recession fears are true, we can see really, really good prices on Target. Walmart might get as hit hard as Target, but I think Target's going to get hit really big, and I think we'll have a chance to see Target fall another 50% or so. I think there's a possibility we definitely will see Target between $95 per share and $125 per share. All right, so those are my price targets. I want to start buying Target under $125 per share. Otherwise, I'm not too interested. Walmart is also sitting at $150 per share on the yearly. Remember, Target's down around 40%. Walmart's up 2%. So that could imply that Target is significantly oversold and Walmart's not. However, I'm sticking to my price targets of $95 per share to $125 per share on Target. And I also want to be buying the same price targets on Walmart. If we see Walmart under 115, I'll definitely be loading heavier. If we see them under 100, that's when I'll be loading the heaviest for Walmart. They're also a good dividend stock, by the way. I just want a better price if I'm going to be coming in as a long-term investor. I'll probably just buy one lump sum around $95, $105 per share and just let it sit for a few years. Okay, now if we take a peek at what analysts have to say about Target, we see there's a 21% average upside on the high end. Some analysts have $223 per share, the low end $161 per share, which is still higher than the current price of $155 per share. Remember, these are predictions over the next 12 months. A lot of these were reiterated just one day ago, just yesterday. Okay, we see a lot of 5-star analysts coming in at $170 per share, $180 per share, $200 per share, $217 per share. So Target could be a good buy around the $155 mark. However, just me personally, my goals are 135, 125 or lower, especially if I can load up under $100 per share. I'll definitely be taking that opportunity. If we look at Walmart on average, there's only an 8.75% upside over the next 12 months in analyst eyes. On the low end, $140 per share. On the high end, $175 per share. Currently, Walmart's at $148 per share. A lot of these are 5-star analysts just reiterating this yesterday. $160 per share, $155, $169, $175. So overall, Walmart is probably the safer bet overall to store your money. However, if you're looking for something with a little bit more risk, a little bit more growth potential, then Target is going to be the better option for you. So I hope that video summed up Walmart versus Target and also a nice Nvidia update for you as well. I hope you appreciate these deep dive, this content that I put out for you guys almost every single day on YouTube and go in great detail and use up a lot of my time to make these videos and edit them for you. There's no team here. It's just me doing all the videos, editing, and everything in between. So thank you guys for all the love and support. All the likes and subscribes mean the world. Also the comments and shares. So thank you. That's really how you can show your appreciation. And just take a second out of your day. And if you're not subscribed yet, just hit that subscribe button. If you're already subscribed on YouTube, hit that notification bell so you're alerted when new videos come out. And if you want to join my close friends list, click on success number 6. I'm taking a few more signups right now so you can actually see the results that other students have had. If you want to become a more professional trader in the stock market, this program is definitely for you. I'll shoot you over my website so you can see what everything includes. If it's inside your budget and it makes sense to you, then let's go ahead and make some money together in the stock market. Thank you guys for all the love and support. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.